if institutional demand and retail demand for silver continues, what you will see is a dishoarding of informal silver, held by living, breathing human beings in the Middle East and in South Asia, and the reintroduction of that silver into the formal system, provided it doesn't happen all at once, provided it happens over time. And I think that this process probably accelerates. You're seeing a conversion of informal silver to formal silver in China, as an example.
The Silver Institute's latest report indicates a significant transformation in the silver market. Industrial demand is projected to exceed 700 million ounces in 2024, marking a 7% increase. This unprecedented demand is primarily driven by expanding applications in the green economy sector, particularly solar technology, alongside growing requirements in the automotive industry for sophisticated electronic components. Jewelry and silverware demand is anticipated to increase by 5%, with India's leading consumption growth and the United States showing strong jewelry sector performance. This robust demand coincides with modest supply growth, as mine output is projected to increase by only 1%, contributing to a continuing physical market deficit for the fourth consecutive year. RickRule identifies an emerging trend in the silver market involving the potential transition of informal silver holdings into formal market channels. This shift, particularly from regions such as the Middle East and South Asia, could significantly impact market dynamics if institutional and retail demand strengthens. The rule notes that evidence of retail holders liquidating positions suggests this transformation is already underway. Supply developments show moderate expansion, with a 2% overall growth forecast. This includes a 1% increase in mine production, primarily from Mexico, Chile, and the United States, complemented by a 5% rise in recycling activity driven by increased Western silverware scrap. The market's strength is reflected in spot silver prices, which have appreciated by 32% in 2024, while exchange-traded products are poised to record their first annual inflows after 3 years of outflows. UBS projects silver prices to reach $36 to $38 per ounce by 2025. This forecast is underpinned by anticipated declines in U.S. yields, expectations of industrial sector recovery, and sustained robust demand. Despite periodic market headwinds, the metal's unique position as a precious and industrial commodity continues to support its price trajectory. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If what happened at that point in time would have been accompanied by a liquidity squeeze, a market event like 2008, it would have been game over. If you would have seen credit restricted in the futures market against good delivery failures in the cash market, it would have been game over. Now, understand that you wouldn't have had a short squeeze like you have in a fair market. The LBMA would have declared something called force majeure, and they wouldn't have demanded settlement in silver. They would have cash settled, and the exchange, would have determined the cash settlement price, just like they did in the tin market. So part of the premise around the silver squeeze, which suggests that we had a fair market in silver, that the exchange isn't controlled by the dealers in the exchange, is false. That notwithstanding, people would have made a lot of money. Understand, too, that the failure to deliver didn't reflect overall physical inventories in the silver market. It involved good delivery, silver. The silver that is the stuff of the paper futures, and the inventory that is required for responsible investment vehicles like Sprott Physical Silver. Over time, if institutional demand and retail demand for silver continues, what you will see is a dishoarding of informal silver, held by living, breathing human beings in the Middle East and in South Asia, and the reintroduction of that silver into the formal system, provided it doesn't happen all at once, provided it happens over time. And I think that this process probably accelerates. You're seeing a conversion of informal silver to formal silver in China, as an example. I think really the possibility for a cataclysmic break really has to do with how rapidly the market would be challenged. We were a catalyst that challenged that market, Chris. And to be honest with you, a fairly small catalyst. The fact that $1.5 billion or $2 billion in net buying had that dramatic an impact on the physical good delivery silver market, let me know just how leveraged the futures market was.
Gold prices continued their upward trajectory on Thursday, marking a third consecutive session of gains following an exceptional performance in 2024. The precious metal's 27% appreciation last year, its strongest showing since 2010, reflects a convergence of supportive market factors, including anticipated U.S. monetary policy shifts, ongoing geopolitical tensions, and unprecedented central bank purchasing activity. Market analyst RickRule provides insight into the divergent performance between gold and silver, highlighting the crucial role of central bank participation. According to Rule, gold's superior performance can be attributed largely to sustained central bank purchasing programs, a dynamic notably absent in the silver market. This institutional demand differential helps explain the distinct price trajectories of the two precious metals despite their traditional safe haven characteristics. The World Gold Council's recent survey indicates that major central banks plan to increase their gold purchases in 2025, suggesting continued strong institutional demand. This forecast, combined with persistent geopolitical tensions in the Middle East and the ongoing Russia-Ukraine conflict, provides a supportive foundation for gold prices in the near term. Let's get back to the interview.
I think the deficit is bigger than we think it is, because I think the informal supply was bigger than we thought it was. I remember all the way back to the middle part of the decade of the 80s when Buffett suddenly reported to the world that he owned 15% of the world's above ground supplies of silver, that is to say, reported supplies. And the silver price just shot. That's before you were in the racket, I think. The silver price just shot up and then it collapsed. And of course, all the silver bugs said manipulation. That's wrong. What happened is that the Indian rupee fell by 50% in US dollar terms and the price of silver went up by 200% in US dollar terms. So from the point of view of the Indian peasantry, the price of their silver went up by 400%. And that occurred in conjunction with a bad harvest in India, where the Indian peasants had a choice between keeping their silver and feeding their kids. Well, that was pretty straightforward. And a whole bunch of silver came out of inventory from a place that we didn't know it had been in inventory. The understanding that I have, and it's a very informal understanding, but the understanding that I have with the Gujarati precious metals trading community, an informal community, I call them traders, their government calls them smugglers, is that there has been substantial physical dishoarding of silver that has accompanied the reduction in the exchange rate between the Indian rupee and the US dollar. And I think that the offtake of physical silver from informal hoarders in emerging markets in favor of industrial application has been greater than we believe it is. We can observe it in official sectors. We can observe dishoarding from industrial refiners like Engelhard. What we don't see is the informal dishoarding that's taken place. And I suspect that the informal dishoarding has been much greater than we believe. And I think that the consequence of that will be that if I'm right about the direction of precious metals prices, that the adjustment between the paper market and the physical market could be much more dramatic than we believe. That the strength in gold is not retail strength. The retail has not been buying it. No. The central banks have been buying it. If you measure popular sentiment around gold with cash inflows to the ETFs, you only saw 5 months of positive flow into ETFs. Right now, you're selling retail selling of gold and retail selling of silver. Why did gold respond and silver not? Well, that's simple. Central banks buy gold. With the exception of stated intentions by the Russian, central banks don't buy silver. So a market that moves as a consequence of the participation of one buyer probably doesn't move in a sector where that buyer isn't focused. I believe that the motivations for central bank buying, one being the weaponization of the US dollar and the extraterritorial imposition of US will, has been partially responsible for central bank buying of gold.
As the silver and gold markets continue to evolve, their distinct roles in both industrial and financial sectors highlight unique opportunities for investors. Silver's expanding industrial applications and persistent market deficits underscore its potential for long-term growth, while gold remains a cornerstone for institutional stability amidst geopolitical and economic uncertainty. Navigating these dual markets demands a nuanced understanding of their contrasting drivers and interconnected dynamics, offering both challenges and opportunities for those seeking to capitalize on their trajectories. How do you see the interplay between silver's industrial growth and gold's role as a monetary asset shaping the broader precious metals market in the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.